As 2014 winds down, investors don't seem to have much faith in the trends they are seeing in the market. Recent good news is open to analysis as bad news today, even though the news itself has stayed the same. One good example of this is energy prices. The value of West Texas crude oil has been declining. Until recently, this trend has been a positive for U.S. stocks. Lower fuel costs free up cash for U.S. consumers, whose spending accounts for roughly 70% of GDP. But this week, declining oil prices are pulling the S&P's 500 index down. Investors are now worried that weak oil demand due to the soft global economy could lead to disappointing earnings in a key market sector. This shift in thinking would make more sense if the market just noticed that oil demand might be weak. But it's old news that developed countries and many emerging markets are experiencing slow growth that affects their energy consumption. The same global growth concerns are being offered as an explanation for flight to safety by bond investors that have driven treasury prices up sharply at the long end of the curve. Largely ignored by eager buyers are new reports that the Federal Reserve may raise short-term interest rates sooner than previously expected, which would be negative for short-term treasury prices. With last week's strong jobs report, the latest news is that short-term rates might rise sooner than previously expected. However, it is important to remember that the Fed is more data-dependent than the market currently expects, and they want to protect the economic recovery as long as possible. So before taking an unexpected action that could rattle markets, the data has to point to an economic problem that needs solving. That is your investment minute for this week, and we will see you next week.